So industry overview. What is equity? As I said, it's an ownership in a corporation. And typically, when you own a piece of a corporation, you're owning that sequence of cash flows. There are two components of possible cash flows for a piece of equity security. One is dividends, but of course we know that there are companies that don't pay dividends. Typically companies that are early stage growth companies, they want to conserve their cash because they've got lots and lots of investment ideas that they want to implement. And so any cash that's generated internally, they're going to be plowing back into current operations. So growth companies typically don't pay dividends. But you still get value from the security because as the firm grows, as the corporation becomes more valuable, that piece of paper that you hold becomes more valuable. So in other words, you get capital gains or price appreciation of that piece of paper. And if you want to get value out of that price appreciation, you can always sell it. Part of the reason that it wasn't very efficient is because we didn't allow you to short sell. And so those of you who had the information that at one point the stock was worthless, the most you could have done was to divest yourself of shares that you already owned. But once you did that, that was the end, and you're out of the market. You couldn't do anything more. If, on the other hand, we allowed you to short sell, you would have driven that price down to zero, where it belonged. The way the venture capitalist ultimately gets paid is not by the satisfaction of being part of your wonderful company, but rather by having your company go public and having the securities be issued so that the venture capitalist can cash out at those public market prices. What this displays is the trading volume, both measured in terms of shares as well as in composite fraction on the NYSE volume. And you can see that over time that the share volume, the amount of shares traded, has just gone up year on year, and this year it will be no different. 2008 will be a tremendously significant year for the amount of shares traded on the exchanges. But there are other technological innovations as well. For example, something called ECNs, electronic communications networks. These are essentially, they started out as bulletin boards where large buyers and sellers of equities could come together anonymously and transact with each other at relatively inexpensive prices. They could cut out the middleman and reduce the bid-offer spread by hitting a transaction price that was right in the middle. ECNs have grown tremendously since the early, the mid-90s when they started, and now account for a pretty significant fraction of the volume. Let me now turn to the very first valuation model that was ever developed for equities. It couldn't be simpler. It's a model that I think all of you are going to immediately understand, and yet the implications are going to be really far-reaching and profound. This is called the dividend discount model. And it starts with the recognition that when you invest in a company, what you're getting for that piece of paper, this common equity, you're getting the rights to the flow of cash forever. And what kind of cash are we talking about? Well, we're talking about dividends. So it's true that not all stocks pay dividends, but eventually you would figure the stock will pay dividend at some point, right? For years, Microsoft never paid a dividend. But about, is it 5 years ago or 6 years ago, they announced that they're starting to pay dividends. Why? Because they accumulated so much cash that they didn't have enough things to invest that cash in, so they figured, let's give some of it back to the investors. In their early days, they kept every penny of their earnings to reinvest because they had so many different opportunities to take advantage of. But because they became so mature and they had already a number of investment projects that were quite valuable, and yet were still generating so much cash, they decided to return some of it to investors. So at some point, you're going to get dividends. And if a company never, ever pays dividends, well, then it should be worth zero, right? If it pays you no cash forever, then that seems like a very bad asset. If, as a company, you have no idea what to do with the money you're generating, well, first of all, that suggests that maybe you're not doing your job because as a company, you're supposed to be coming up with valuable ways of earning money for your investors. However, it may be that your company is very mature, stable, there's no growth, there's nothing going on, and all the cash that you're generating, you don't know what to do with. In that case, you may very well return all of that money to investors. Nothing wrong with that. Well, but think about it. If a company keeps on appreciating in value but never pays out a dividend, what's happening to the cash? You know, when I say never, I mean never. So I don't just mean like in 10 years or in 20 years, I mean never. So can you think of a company that appreciates in value all the time, but never, ever, ever pays a dividend? There's no cash, so you'll never get any cash. That's... Oh yes, you could. You could make a profit by selling, but if you sell a security to somebody else and they know for a fact that it never, ever, ever, ever pays any money, well, then that's called a Ponzi scheme, right? In other words, you're selling a piece of paper that's worthless to somebody and hoping that they're a bigger fool than you are for having bought it. So when I say it never pays any cash, I really mean it. If you know for sure that it never ever pays any cash, then it can't be worth anything, right? If you don't believe that, then I have a piece of paper that I would like you to take a look at, and I would like to sell you. Okay. What determines the yield is the riskiness of that yield and the marketplace. The market determines that particular price, not the individual or not the uses or not the sources of those funds structure. Companies that have very high leverage are going to have more risky equity than companies with very low leverage. So the leverage does have an impact on the equity. Well, they get to decide what the dividend is subject to their ability to pay that dividend. But if it turns out that they make a bad decision and they pay out all the dividends and they have no more money and they can't grow the company anymore, then who determines what's worth what? Ultimately, the market. In other cases, you could argue that corporate decision makers know more than the market and are able to make bets that the market is not capable of doing. That's certainly possible because who knows the company better than you do? Although a markets expert would say it's not knowing the company that will determine the value of the company. It's knowing how that company compares to all the other companies that are out there that determines the value of the company. And you, as the corporate insider, may know your business very well, but you don't know how you stack up against the 25 other businesses in your industry, and we, the market, know better than you, the individual. That's the argument that would be made against that. The way that the market is going to evaluate the different pieces is just the way that I described. They're going to look at each cash flow, look at how risky it is, look at the opportunity cost of other investments that they could get the same risk-return profile for, and they'll pay that amount, which will implicitly give me the appropriate yield. But it could be that you simply want the risk and reward of this particular cash flow. What's wrong with that? Suppose that the security is fairly priced. So this equation at the very bottom says that the price of the security is equal to the present value of all the future expected cash flows discounted at the fair rate of return. That's a perfectly reasonable thing for somebody to want to invest in if they like that kind of risk-reward combination. Now, if you think you've got a better mousetrap and you can identify mispriced securities, that gives you a whole nother reason for investing. Another insight, though, is that the price of a stock is inversely proportional to its discount rate. If interest rates go up in general, if interest rates go up, what should happen to the stock price? Exactly. It should go down. There are two ways of thinking about it. One is that future cash flows are going to have to be discounted at a higher price. Or two, the demand for stocks will not be as great because now the opportunity for earning higher return exists in other securities like bonds, and so that will reduce the demand for stocks. The price will come down.